On January 1st, 2026, thousands of Singaporeans will log into their bank portals and notice something unsettling. Despite no change in their gross salary, their take-home pay will be significantly lower. We are at the final stage of the CPF wage ceiling hike, where the ordinary wage cap hits $8,000. For anyone earning above the previous thresholds, this isn't just a policy update, it is a fundamental shift in your monthly cash flow. But what if this pay cut is actually the most powerful wealth-building tool you've ever been forced to use? Today, we are deconstructing the $8,000 CPF hack to turn a liquidity crunch into a long-term windfall. To understand where we are going, we have to see where we started. Since September 2023, the CPF board has been aggressively raising the monthly salary ceiling from $6,000. It moved to $6,300, then $6,800, then $7,400, and finally, the Jan 2026 milestone of $8,000. This deliberate multi-year phase was designed to help employers and employees adjust, but many are still unprepared for the final jump. This hike specifically targets middle to high-income earners, forcing a larger portion of your gross pay into the locked ecosystems of the OA, SA, and MediSave accounts.
Let's look at the cold, hard numbers. If you earn $8,000 or more, your employee contribution at 20% now equals $1,600 monthly, up from $1,200 back in 2023. That is $400 less in your pocket every single month. However, the employer contribution also scales. Your employer now chips in 17% of $8,000, which is $1,360. Total monthly CPF contribution, $2,960. That is nearly $36,000 a year being funneled into your accounts before you even consider your annual bonus. The question isn't how to get that cash back, but
for those with high fixed costs, mortgages, car loans, or private tuition, this $400 monthly reduction in take-home pay can cause a genuine liquidity squeeze. If you are living paycheck to paycheck on a $10,000 salary, 2026 is going to feel like a recession. This is the liquidity trap of the CPF system. Your net worth is growing faster than ever, but your spendable cash is shrinking. To survive this, we have to look at the ordinary account not as a retirement fund, but as a dynamic cash flow offset. Here is the first hack. Many people focus on the 20% they lose, ignoring the 17% they gain. The ceiling hike to $8,000 means your employer is now mandated to give you an extra $340 per month compared to the $6,000 ceiling era. This is a non-taxable 100% return on your forced contribution. In a standard brokerage account, you would need to invest tens of thousands of dollars to generate $340 in monthly dividends. In the CPF system, this is a guaranteed raise that you simply haven't figured out how to spend yet. The most effective way to solve the 2026 cash flow crunch is through mortgage optimization. With the higher ceiling, your monthly OA contribution is now significantly higher. If you are currently paying your mortgage with cash to save your OA for the 2.5% interest, it's time to pivot. By switching your mortgage repayment to your OA, you can effectively refund your take-home pay. The extra $400 taken from your salary is now being covered by the extra OA contributions, neutralizing the impact on your lifestyle while still building equity in your home. The CPF ceiling hike is also a hidden tax gift. Since CPF contributions are deducted from your taxable income, the Jan 2026 hike effectively lowers your assessable income by thousands of dollars annually. For a high earner in the 15 or 18% tax bracket, the $8,000 ceiling can result in substantial tax savings. You are essentially trading taxable take-home pay for non-taxable, interest-bearing retirement savings. When you combine this with the SRS, Supplementary Retirement Scheme, you are creating a massive tax-deferred wealth engine that the average person completely overlooks. We must address the elephant in the room, the closure of the special account for those aged 55 and above. With the $8,000 ceiling, younger earners are pumping more into the SA than ever before. But once you hit 55, that SA closes and the funds move to the RA. The hack for 2026 is proactive shielding. You need to maximize your SA early to hit the full retirement sum as quickly as possible, allowing the 4% compound interest to do the heavy lifting before the 2026 rules and future age-related shifts change the game again. Now that the mandatory ceiling is $8,000, should you still do voluntary top-ups? For many, the answer in 2026 is no. Because the mandatory ceiling is so high, you are already hitting the annual CPF limit. The annual limit is currently $37,740, much faster. If you earn $8,000 a month plus a 3-month bonus, you will hit the limit purely through mandatory contributions. This frees up your remaining cash to be invested in more liquid, higher-yielding assets like global index funds or private equity, rather than locking more into the CPF ecosystem. Let's compare two earners in 2026. Earner A makes $6,000 and is unaffected by the hike. Earner B makes $8,000. Over 10 years, Earner B will have nearly $150,000 more in their CPF than they would have under the old $6,000 cap, purely due to the ceiling hike and compound interest. This is the wealth gap that is being structurally built into the Singaporean economy. If you are in the $8,000 bracket, you are being forced into the wealthy category, whether you feel like it or not. The key is not to fight the system, but to optimize around it. If we project the $8,000 ceiling out 30 years, the results are staggering. For a 30-year-old earning the ceiling today, the total CPF balance at age 60, assuming no salary growth beyond the ceiling, could exceed $1.5 million. This hike ensures that the middle class of 2026 becomes the multi-millionaires of 2056. But this only works if you don't allow lifestyle creep to consume the rest of your take-home pay. You have to treat your reduced salary as your new baseline and invest the difference. The $8,000 CPF hike isn't a hurdle, it's a blueprint. By January 2026, you need to have adjusted your budget, optimized your mortgage, and reviewed your tax strategy. The government is forcing you to save more. It is up to you to ensure those savings are leveraged for your freedom, not just your retirement. Audit your contributions today. Check your projection, and most importantly, prepare your cash flow now so that when 2026 arrives, you aren't just surviving the hike, you're profiting from it. The math is clear. The move is yours.